Okay, students, we're back and we will talk about the depreciation methods now. We'll start with straight line. Now, straight line gets its name from the idea that if you were graphing depreciation expense over the life of the asset, you just have a straight line. It takes the cost of the asset, subtracts residual value to get depreciable cost right here, and then divides that by the useful life of the asset. So if an asset cost $110,000, has a residual value of 10,000, that would give us depreciable cost of 100,000. And let's say it has a useful life of 4 years. You would divide 4 years into $100,000, get $25,000 a year. Now they give you an example down here of an asset that has cost of $62,500. You'd have to look and see where it's discussed up in the problem up here, but I'm not going to worry about that. We can tell from the chart right here. Had depreciable cost 62,500, residual value of 2,500. So we subtract, get 60,000 in depreciable cost and a 3-year depreciable life. So 60,000 divided by 3 gives us 20,000 a year, or times 1/3. So you see, each of the 3 years of the asset's life, we're taking $20,000 depreciation. At the end of 3 years, it's what we called fully depreciated, meaning all of the depreciable cost has been charged to depreciation expense. Okay, and so there we see the remaining book value or net book value. At the beginning, at the time of acquisition, it was $62,500. After 1 year, it goes down by 20,000 to 42,500. Year 2, it goes down by another 20,000 to 22,500. Year 3, it goes down by another 20,000 and is down to 2,500. Okay, straight line's easy. No problem. You will not have any problem with it. Now, units of production measures the life of the asset in some measure of use rather than time. So straight line or double declining balance method use time as the measure of how we determine depreciation expense. Units of production ignores time. It's not concerned with how old the asset is. It's concerned with how much it's been used. And so for a vehicle, rather than depreciating it on a 5-year, 7-year, 10-year life, whatever you think is appropriate, we instead say, okay, I think this vehicle is going to last, let's say, 200,000 miles. So let's say you paid $40,000 for it, and you estimate, let's just say, a 0 residual value and a 200,000 mile life. You would divide the 200,000 miles into the $40,000 depreciable cost and come up with depreciation of 20 cents per mile, I believe that would come out to. And so then any given year, you say, how many miles did we drive it? Let's say it was 10,000 miles. Well, 10,000 miles times 20 cents per mile would give you $2,000 depreciation. So you see that right here. Cost minus residual value, again, gives you depreciable cost, times the actual miles driven divided by the estimated total productive life, total number of miles you expect the vehicle to last. So the units of production that are used can be measures of input or output. Mileage would be a measure of output. Sometimes we do it based on, for example, machine hours, number of hours of the machine was run. That would again be a measure of output. If you're trying to think, well, what would be a measure of input? Those are less common, but you do run into them occasionally. Let's say you have a piece of equipment and the easiest way to measure it, let's just say it's some kind of a saw. And so you just measure the number of board feet that it has been used to cut. That's a measure of input. So any measure that you find appropriate. Commonly, airlines use number of miles driven, or excuse me, number of hours flown. But Southwest Airline at one time, they don't use this anymore. I looked at their financial statements, but at one time they used number of landings because their argument was once you get up and flying, the plane doesn't incur a lot of wear and tear. It's the landings that actually wear out an airplane. So they used estimated life based on number of landings that the plane made. So that's units of production. Now, the declining balance method, most often referred to as double declining balance. Declining balance just means you use some multiple of straight line life, percentage life. So if we had a life of 5 years, straight line, that would be 20% per year. So declining balance, we take some multiple of 20% per year. Now it's almost always double. So hence referred to as double declining balance. So rather than taking 20% per year, you take 40% per year. But with the declining balance method, it works very different. What we do each year is we don't forget about the residual value, but we don't use it in the calculation initially. We take the cost minus accumulated depreciation times double the straight line rate. Now, cost minus accumulated depreciation is book value, net book value, carrying value, any of those you want to call it. Again, I will usually refer to it as net book value, but we take the net book value times double the straight line rate. Now, where residual value comes in is we never want to depreciate it below residual value. So you can see here in the last year, in the third year, their calculation of net book value times double the straight line rate would have caused it to be depreciated below residual value. We don't want that to happen. So in those later years, when we get close to the end of the depreciable life, we have to pay attention and make sure we don't record too much depreciation to record it to get net book value below residual value. Okay, we stop depreciating it when we get down to net book value equals residual value. Now, sometimes you have the opposite problem, and that if we have zero residual value under double declining balance method, we would never fully depreciate an asset. So even in a case like this with a 3-year life, you're taking 2/3 of the net book value every year. Well, if we take 2/3, we always have 1/3 left. So first year, we take 2/3 and we have 1/3 left. The next year, we take 2/3 of the net book value at the beginning of that year. There's 1/3 of that net book value left. The next year, we take 2/3 and there's 1/3 left. Now, that is a very small portion, but you're always going to leave that 1/3 behind. So There's actually ways that we deal with that, but that's kind of beyond the scope of this class. So I'm not going to confuse you with that. We won't deal with situations like that in this class, but we will deal with situations like this one here, where in the latter years we have to stop depreciation when we get to net book value down to residual value. Okay, so there is an example of the depreciation expense under the three methods. So you see under straight line, it's the same each year. Under units of production, it varies with production or use. And under the declining balance method, that is what we call an accelerated depreciation method, because we take more depreciation in early years and less in later years. Now, one benefit of the accelerated methods is, if we stop and think about it, depreciation is going like this. Well, what happens to maintenance cost? Well, early years it's very little, and later years it gets to be more, so it's going like that. So total cost of operating the equipment or the asset under the declining balance method may be relatively stable, in that when depreciation's higher, maintenance costs are lower. When maintenance costs are going up, depreciation's going down. With straight line, depreciation staying the same, but maintenance costs go up. So cost of operating the asset go up over its life when we take into account depreciation plus repairs and maintenance. Okay, the declining balance method, they walk you through that here. Cost minus accumulated depreciation gives us book value at the beginning of the period. And so we take that times double the straight line rate. So 2 over the straight line. So if our straight line life were 5, 1 over 5 would be 20%. Well, 2 over 5 would be 40%, double that. And that gives us our depreciation expense for the year. In the first year of the asset's life, accumulated depreciation is 0, so we're just taking cost, not depreciable cost, just cost, times double the straight line rate. Okay, because residual value is not included in the formula for the declining balance method of computing depreciation expense, you must take extra care to ensure the asset's book value is not depreciated beyond its residual value or below its residual value. So if the calculated amount of depreciation for the year would reduce the book value below the asset's residual value, you must record a smaller amount of depreciation so that the book value will equal the residual value. No depreciation is recorded after the book value reaches residual value, even if the asset continues to be used. Okay, I hope you understand that. We will go through homework examples at the beginning of the next video. And you should, going through those homeworks should kind of cement these ideas, these rules. If it doesn't, work some extra problems. Go back through the ones that they give you in the book. Go through the homework problems multiple times. So with that, I will end this video, and we will start with mini exercise 9.4 on the next one.